Welcome to this month's update of our Chronicle of a Real Money ASX stocks portfolio for the end of August 2023. This is where we put it all out there, warts and all, so you can see exactly what investing using a trend-following systemized process is all about and why it works long-term. The great thing about telling a story of a real money portfolio that's been transparently watched by our members from the beginning is that there's nowhere to hide. We all walk the path together in real time and learn from those experiences together. And now you can follow the journey too, as it happens here on YouTube. Now, you may have seen some of the videos that we've put out this month on Fortescue Metals, Origin Energy, and Computershare, which are all trades that were taken in this portfolio. They've been both winning trades and losing trades, so you can see what the day-to-day experience is all about. Now, in these monthly updates, I benchmark or compare against the ASX200 Accumulation Index. If you're not familiar with it, the ASX200 Accumulation Index is an index that follows the largest 200 Australian listed companies and their performance as a whole, and it also includes dividends. It's basically an indication of how the overall market is performing. And we know that most balanced funds or managed funds or even index ETFs slightly underperform the market over time once you take out their fees. So it's a good one to use for comparing active versus passive investing over the long term, even though it's not 100% apples for apples. Now, while we do these sessions monthly and we show the performance in real time, it's the big picture that's the most important thing. When investing, you're going to see positive months and negative months as those winning and losing trades play out. However, you're not just investing for a month or two, are you? You're investing for a lifetime, or at the very least, well into your retirement years. So it's not 1 month's performance or even 1 year's performance that'll make or break your portfolio. It's the culmination of all of these months, years, and decades all put together that helps you achieve your long-term investing goals. Of course, you don't look at the value of an investment property every month and make rash decisions based on a month or two of positive or negative gains, do you? It should be the same with your stock market investments. No portfolio will ever go up in a perfect straight line, and nor should you expect it to. Whatever investing strategy that you follow, you want it to be able to ride out the inevitable short-term volatility and beat the market over the long term. Let us know in the comments below how your portfolio has been faring over the last couple of months, but also over the long term. So while we suggest you only care about the long term because that's what will matter to your retirement or your long-term goals, as part of our commitment to transparency, we show you our real money portfolios in all different timeframes. That way you can see all the ups and downs and learn from our journey, allowing you to shortcut your own path to becoming a successful and peaceful investor. So let's start with the important stuff and take a look at the big picture first. Since taking our first trade at the start of 2016, right up until the 31st of August 2023, our real money ASX public portfolio has grown 145.82%. That equates to 12.44% per annum. The market, on the other hand, the ASX200 Accumulation Index, has grown at a rate of 8.58%, or only 87% in total. We originally started with $80,000, and that extra few percent of year outperformance has equated to tens of thousands of dollars more in just over 7.5 years. If we took that type of outperformance and drew it out over a 20-year period using a compounding calculator, you can see the story really start to unfold and the gap get wider and wider. 8.58% would help you grow an $80,000 portfolio to over $415,000 over a 20-year period, which would seem pretty good, right? But just doing a few percent more and achieving 12.44% per year more than doubles that, growing to a whopping $834,654. Now, of course, you've got to take taxes out of that, but you can see why having a big picture perspective is so important to helping you see through periods of short-term volatility. When you can see the big picture and you have a plan that takes you where you want to go, you don't need to sweat the small stuff. And who would have thought that only 4% per year more could more than double your money over time? It's no wonder that Einstein called compounding interest the eighth wonder of the world. It makes a colossal difference to your performance over the long term. We speak to so many investors who start off in the markets that have a rough few months when they begin, while they're learning, and they get caught up on the short-term mentality. Then they give up altogether, thinking that they can't do it themselves, when the reality is they might just not have had the right strategy, or they picked a tough time to begin. They unfortunately then make the mistake of putting their money back into an average fund that gets an average return of about 8% per year. They don't realize it at the time, but this mistake may actually cost them hundreds of thousands of dollars over their investing lifetime. If we had that sort of short-term mentality, we'd be giving up right now after seeing a 4.7 loss in our portfolio last month. We would have been worried about the economic slowdown in China, the lingering inflation issues, and the fact that Fortescue senior management are all running for the door. But we don't worry because we know that there's going to be months that we see good gains too. And last month was just one part of the overall big picture. If we look at the past year, our portfolio gained 2.99%. In 4 years, our real money portfolio has grown 37.71% compared to the market at only 28%. In that time, we also had the COVID crash where many people had to watch their portfolio fall by 30% or more because they didn't have a strategy to get out. You can see on the chart here where our portfolio did see some drawdown, but moved quickly to cash by selling out during COVID, protecting against the majority of the fall. And at 7 years, our portfolio has grown 122% versus the market at only 78%. Of course, when we go all the way back to inception, like I showed you before at the beginning of 2016, we get to see the really big picture. The portfolio has grown 145% compared to only 87% with the market or the accumulation index. As time goes on, that gap just gets wider and wider because we've got more money to invest and can therefore grow the actual size of the portfolio at a much higher level, compounding profits on top of profits. And when the market crashes again sometime in the future, and it definitely will crash again sometime in the future, our members get out and protect rather than going down with the ship, leaving them with more money in their pocket to invest going forward. Just like after the COVID crash and the GFC. It makes your investing much less emotional and stress-free while also helping to grow your portfolio at a much greater rate. That's why our members choose to approach the market in this way. It's about running a sustainable portfolio in a consistent manner to grow your money much more over the long term. You want to be a peaceful investor who's ready for the next curveball the market throws at you, not a stressed out, anxious investor always worried about what's around the corner. Having a systemized trend following process that always tell you exactly what to buy and when to sell can do that for you. So if you have an interest in seeing how we approach the markets and would like to take a run through it with me personally, feel free to call, send an email, or book in a Zoom chat. And of course, if you want to keep up to date about the new positions we've bought or sold off and learn all the ins and outs of trading the stock market with a system, then subscribe to the channel and tap on the bell to get notifications on all the latest. As always, this video is for education purposes only and shouldn't be taken as a specific advice as to buy, hold, or sell any particular instrument in the market, and that past performance is not a guarantee of future performance. Okay, until next time, where I look forward to showing you around the markets again, I wish you consistent and objective investing. Bye for now.